From the morning reading, the diamond's new all-time high as the spider pauses in light volume. 2 of 9 sectors moved higher on Tuesday. XLI, XLF, and XLP were the strongest sectors, while XLB was the weakest sector. Oil futures fell 46 cents to close at 45.45. Breath weakened compared to the prior session as decliners led 1718 to 1247 on the New York Stock Exchange and led 1658 to 913 on the Nasdaq. Diamond was the only broad index ETF to make new closing highs on Tuesday. The Diamond was led by gains on McDonald's at 2.18%, J&J 1.71%, United Healthcare 1.3%. 15 Dow stocks rise and 2 were unchanged. Dumb money is more confident than smart money. The latter dropped again on Tuesday to only 18%, while the dumb money is 76% confident in the rally. While a wide spread is not necessarily a good sell signal across a consistent time frame, every time in 20 years that it dropped to this negative of a level, any further short-term gains when stocks were erased during a subsequent pullback. The VIX fear gauge dropped below 12. When it fell below 12 for the first time in months, stocks struggled a bit, but the VIX did not. It rose over the next 2 weeks every time with an average spike of 20% at some point. Also, the ratio of near to far-term volatility expectations is the third lowest in a decade. Other times, the term structure dropped below 0.80 and marked lows in the VIX, but not necessarily tops in the S&P 500. Of the 39 times the term structure has been below 0.80, the VIX was higher 2 weeks later 37 times, averaging 11%. Microsoft is on track to gap up more than 3% on Wednesday. If so, it'd be the 8th time in the past 25 years that it opened more than 3% higher in July, typically in response to its earnings release. Notably, from that day's open, though, the next 6 days, it lost value every time. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 5:50 a.m. Mountain Time, and I'm recording this in preparation for the market day of July the 20th, 2016. Remember that on YouTube, you have a free subscription to the channel and are alerted to new content being posted. Give the video a few minutes after being published for the video to be available in high definition. Click on the setting button to choose the high definition playback level. In this same area, you can also control the speed of the playback. I routinely find that I can fully understand videos at about 1.5x the recorded speed. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's see what happened in the overnight. And on our morning report, generally things are fairly positive. All 4 of the U.S. broad-based indices are up, with the S&P futures up at the time of this cut about 0.25%. Russell futures up just under 0.5%. Nasdaq a little bit more than 0.25%, as is the Dow, also a bit more than 0.25%. Crude oil just up, just above scratch. Euro down just below scratch. Bonds down about 0.25 point, and gold down about 0.75 point. China's down about 0.25 point. Hong Kong going the opposite direction, up about 1%. Japan down about 0.25 point. In Germany, up about 1.25 points. In the United Kingdom, up about 0.25 point. And macroeconomic reports of note for today in the United States, you have crude oil inventories, and that's about it for the U.S. Looking forward to tomorrow, you have Philly Fed manufacturing, the weekly unemployment claims, and existing home sales. In terms of current volatility conditions, You heard actually a couple references to volatility in the morning reading. Some of the authors mentioning really very exceptionally low levels. And indeed, the short-term VIX is now down to an 11.02. The regular VIX is down below 12. And the skew, 129.92, is slightly elevated just above the first level of warning. IV percentiles all single digits and just about cannot get any lower. The S&P at a 4, the Russell at an 8, the NASDAQ at a 2, the Dow at a 0. What we look for when we see these very, very low levels is, of course, a spike in volatility. And, you know, just because things are low doesn't mean that you expect that spike in the short term. But certainly things are getting exceptionally low, and the probabilities of that spike being around the corner in a relative short-term increase as you prolong. But don't get lulled into thinking that it is imminent. It can stay very low, especially during summer doldrums, for prolonged periods of time. So if you do some sort of volatility play, you need to buy enough time to actually see yourself become correct. No standard deviation moves were put in yesterday. So very, very quiet. In fact, when we go to the charts, just a second here. There we go. So we see on the S&P futures charts, we've had this breakout. We've kind of consolidated a little bit. Right now, we're pushing the upper edge of that consolidation pattern. And really, it was kind of a sideways consolidation. I can't really see any kind of obvious bull flag in here. Basically, just sideways consolidation by time. Right now, we are pushing the upper limit, primarily pushed by some earnings reports, it would appear. Nothing terribly exciting, but obviously, if we break out above this kind of sideways resistance, as it were, right now, which is centered somewhere about 2168. We're currently trading about 3 points below that. If we push back up through the Globex high and through that area, we kind of open up the possibility of moving higher today. Obviously, the cash participants have not yet weighed in. So when that happens, in about an hour and a half from now, at the time of this recording, we'll see just how much juice the broad market brings to this. But bottom line is that there's nothing terribly scary or fearful at this point, other than the fact that we seem to be in something of an exhaustion pattern. Exhaustion can be relieved in a number of different ways. Exhaustion can be relieved by time. If you go through a sideways consolidation path, you can eventually kind of sop up the weak shorts and so forth, and they just kind of run out of patience, and then you eventually can break out and make another leg up. Or, of course, we could have a retracement, and the retracement certainly at this point would be expected to be relatively small and more of a buying opportunity than anything else. Indeed, we are taking the stance that any pullbacks are just expected to be bullish opportunities until proven otherwise, given the current market condition and posture from all of our various indicators. And you take a look at the Dow. The Dow, of course, yesterday had a new closing high, and thus far today is adding to that. Dow and the S&P, of course, have been the leaders in this breakout. The NASDAQ, having made a very important diagonal breakout and then a shorter term horizontal breakout, has also been in something of a little bit of a consolidation pattern, moving up as well, though it still has some distance to make. If we're at 4620, we would seem to have another 120 points to go before it were to take all-time highs. But we're starting to get into an area where there's not an awful lot of overhead resistance until we get to those all-time highs. So the NASDAQ could clearly make a move that could run 70 to that 120 points without an awful lot of natural resistance. The Russell, also very much like the NASDAQ, having broken through diagonal and short-term horizontal resistance, has the opportunity to break from this area And you see it's been running up against this swing resistance and has consolidated sideways. If it should break through that area, it likely will run up to the 1266 area and its former all-time high area as well. In terms of VIX, let's take a look at that, and you see just how low the VIX is getting. And to go back to historical lows, I mean, it normally doesn't get an awful lot lower than this, but if we were to go to 2 years, I want you to note here, last summer, prior to the August spike, it was down here at these levels. Look at this. See, this is the same time last year. So July, August, it spent weeks down here at a very, very low level of volatility. Really, you could even take June with one little hiccup where it bumped up, not much, but just bumped up a little bit and then resolved back. But we basically spent, you know, June, July, August, all 3 months of the summer before that mid-August spike of last year, before we really had a significant volatility event. Obviously, it did eventually come, and that's what the anticipation is when you start putting on these short to intermediate term volatility opportunities as part of your strategies. And whether we get something the size of last August or not, you know, is to be seen. Of course, this is the recent event with the post-Brexit. But if whether we get an event like last August coming out of these low levels, you know, that would certainly be extraordinary. But the point is an expectation of increasing volume as you you know, get to these very, very, very low levels. So kind of keep that in mind on your watch list and looking for opportunities. We in the trading room have been scaling into some positions as volatility has dropped. First when we got below 13, and then when we got down to 12.5, we've been looking to add to that. And frankly, now that we're tickling with 12, we definitely want to add more to that. So we're going to be looking for opportunities to do that in the trade room for sure. In terms of some of our other markets, crude oil, you see it's still in this kind of downward, what we believe is probably a wedge forming. We'll continue to watch this. It's in a very neutral stance though, right smack in the middle of the cloud. So very, very little real opportunity in the very short term for crude oil to move either up or down in any significant way. A really poor kind of setup for an entry in crude oil on most of the upper time frames at this point. You got to wait and see where this breaks out of this pattern. In terms of gold and our other safe haven statuses, as the markets have gained in confidence and bullish momentum, we have seen gold selling off, and we've also seen bonds, long bonds, selling off as well, and that certainly seems to be continuing at this point. Okay, I think that's probably enough with the charts for today. Let's go ahead and go to our daily report. And as you would expect, when things are this solidly bullish, not a lot of change from one day to another. We are very much ensconced in a bull trend at this point. Intermediate term phase opinion, market phase 2, trend reversal, the breaker diagonal, and now horizontal resistance on our S&P benchmark. The 3 market timing signals, no change from yesterday. IBD confirmed uptrend, bullish. GMI index 6 out of 6 and 8 out of 8 on the 2 indices. Buy signals in place since 7-1. Decision point scoreboard is an almost universal agreement. We're still waiting for these last few bearish signals on the long-term time frames across the various indices to turn up. It would seem that we must be getting close to that. Position sizing opinions on both models are at 100%. Intermediate term market postures, severely strong bulls, and you note that they're just about out of room to be able to get any stronger. This is supported by a bullish sentiment line. So with that, the expectation is that bearish legs to the chart will be short and just in pullback mode until proven otherwise, and that bullish legs will be longer and more pronounced and go further with this kind of a sentiment line. The strength of the trend is quite strong. Hedge warning status 0+, normal with some cautionary aspects, and frankly very few cautionary aspects at this point. In terms of our strategy opinions, no change from yesterday. VIX is in the acceptable window to initiate new positions for novice traders. Just be aware that at some point we're going to get a volatility spike. Be ready for that. Make sure your position sizing is appropriate. Covered call strategies and put selling, both are acceptable to initiate new positions. Do keep in mind, we had some of that morning reading talking about, you know, when the VIX first goes this low, drops below 12, you know, stocks tend to historically struggle a bit. And, you know, on the average, you know, there's not a lot of pot odds gains to be had with an entry at this point. Now, if we break out and perhaps set up for a new leg, that might possess some new opportunities. But it's starting to become perhaps a bit difficult to add to this position unless we get a pullback. If we get a pullback, then your watch list goes into full action, probably selling some puts or put spreads, using defined risk positions and position size in the scale that you're willing to own should that pullback develop into something more, always maintaining your risk profile. But if you've not been gaining additional delta exposure, it's getting to be a kind of tough place to add now. But at the very least, tiptoe in, adding a little bit at a time as you gain confidence in the bullishness breakout. In terms of specific warnings, same true, borderline warnings in the volatility basket. Nothing really here to get too excited about. In terms of trend base, you also have no warnings at all. And intermarket risk aversion indicators, all 5 are solidly in the risk on position. So when you put all this together, you've got 2 weak warnings from the volatility basket, and you have these remaining bearish signals on the long-term decision point scoreboard status group, and that's about it in terms of current warnings. Really, from the charts, all you could argue at this point is potential exhaustion and the expectation, the growing expectation of the potential of a reversal, but that reversal would be expected to only be a pullback at this point. In terms of sentiment, you see some of that sentiment from short term has scrubbed off, but medium term it's slightly elevated. Bonds also slightly elevated. Others with ETFs with very high sentiment would be the industrials, retail for 2 sectors, and then the mining industry group ETF. So watch for potential reversal patterns amongst those particular ETFs. With the fear and greed index, you see it's a little bit lower than it was yesterday, but it is still very solidly up here in the extreme greed quartile. So once again, that just reinforces the need to watch for potential reversal patterns. In terms of sector percent change, it is a sea of green across all time frames, all sectors. There is nothing here to get you particularly excited. In terms of percent change, you see it was slightly weak yesterday, almost across the board, with only financials and industrials squeaking out just above scratch days. So nothing particularly exciting to get focused in on either the gainers nor the losers. Materials and energy were the primary ones to give up. A couple high beta sectors, but then we also had a high beta sectors with the financials that, you know, hold on to a slight positive. So can't really see much in the way of rotation between the stubs, those staples, telecom, utilities, and bonds. versus those higher beta, more risk on kind of sectors at this point. So that's about it for today. We're right at 20 minutes, which is where we like to be on the recording. And let's go ahead and wrap this thing up. As we go to our disclaimers, hit the pause button if you need more time to review the disclaimers. And then, of course, go to the full disclosures by going to this hyperlink down here at the bottom of the page. We'll see you back here tomorrow morning for the Falcon Global Market Preview. Manage that risk and good trading.